Hi, my name is Kunal, and welcome to the Geeks of the Valley podcast, which connects with some of the brightest minds globally who are leading their respective industries today to discuss the hottest upcoming industry trends and how their work is affecting the global economy. From Singapore early this morning, we have Darren with Tradable Patterns joining us to talk about the economy and COVID. Darren, thank you for joining us, and how are you holding up there in light of the coronavirus?
Hi, Kuno. Thanks for having me here, and thank you everyone for tuning in. I would say that it's been difficult for most people here in Singapore. The measures just escalated on the social distancing and on rules around just not being out and about unless absolutely necessary. So most people work from home. I know some friends of mine who actually work from offices where I believe there's a maximum of 25% of the staff of that office being allowed in the office at any one time. So there are a lot of rotations going on. It's not like everyone works from home continuously, but yeah, look, we are all basically learning to adapt to this. I hate to call it a new normal, but a new normal for the time being. And it's an opportunity, for some, obviously, and we'll talk a little more about what those opportunities may be for certain industries, certain individuals. Certainly, there's always a silver lining when it comes down to tough times like this.
Right. No, I agree, and this virus it's going to have a massive impact on certain areas, on where people choose to live their daily life, right? All of this is being done online, such as food delivery, grocery shopping, Zoom calls for work. And so what are some of the impacts that you see for the economy, and what do you see in regards to the certain companies that have really take advantage of what's going on with COVID and being able to positively make an impact on the population?
So, as you alluded to, quite a few of the online platforms have actually done just fine. In fact, some of them are probably seeing record amounts of transactions going through. Although, I guess online food delivery or just online food platforms, food purchasing platforms, as well as all the online retailers of any kind, really. I would say that if a lot of these websites, these e-commerce platforms weren't fully ready for the surge in traffic, in the time since COVID has become an issue around the world, certainly a lot of these platforms have quickly upgraded their back end to ensure a smooth experience for the end user. So anyways, a lot of these, I guess, names are pretty obvious. Obviously, we can talk about the medical suppliers as well. A lot of suppliers of masks, the N95 masks, which are much harder to produce, much more scarce relative to the demand that we've seen. They've done just fine. A lot of other companies have actually pivoted into mass production. Companies like Zara and a lot of traditional retailers who have never been associated with medical equipment or supplies were actually compelled, partially from the financial opportunity that exists, but also just due to some political pressure that they would have felt in their respective countries, to basically shift some of their production, from manufacturing clothes into manufacturing masks. And so it's been good to see, how flexible some manufacturers are. Obviously, it's been a great opportunity for those who've managed to get products out the door, and to meet that demand. Although, just one thing I'd like to note is that a lot of these medical products, they actually have to be certified in a lot of the markets that they're destined for. So the EU, the US, and even China, they all have their own
Right.
certifications for various medical products. And so obviously a lot of those manufacturers who traditionally had no medical equipment or supply manufacturing expertise, they've just suddenly pivoted in the last 2 months, and so there's no way they'd be certified on those particular requirements that the EU and the US and other markets previously would demand. And so there have been some exceptions, where certain governments, or even more sort of at the grassroots level, at the hospital level, would make exceptions, just because of the overwhelming urgency that most of them felt for these supplies. Around, I guess, other sectors, I'd say, okay, so obviously we know about how tourism's been massively hit. We know about how even some traditional education groups have been hit with schools closing and whatnot. And when I say schools, I'm referring also to the private institutions, those that provide tutorial services where students, public school students would normally go to after the classes end and so forth. So basically, any kind of these former sort of traditional education groups would have felt compelled to embrace e-learning, for instance. And so with that comes as well sort of the technologies around web video conferencing. So you had mentioned a bit about that as well. And so companies like Zoom obviously have been in the news a lot for a variety of reasons. You may have heard about some of the security hose, which software has been identified as exposing, or as having been exposed. And so these are companies which obviously are, on the one hand, seeing a surge in demand for the most part, but also experiencing the kind of challenges that go with that surge in broadband use. And so you may have heard that some governments around the world have actually discouraged an unthrottling of bandwidth from some of the telcos. And so some of the telcos would be encouraged to basically adopt, well, you could call it selective throttling of bandwidth to certain streaming websites. So even YouTube, if you think about it, for all the for all the demand that we've seen with people being locked down and having to watch content online on YouTube to stay entertained or whatever, there is a sort of default streaming of a lower resolution feed, oftentimes that perhaps you've noticed on YouTube. And so for a lot of the video streaming companies, obviously, again, on the one hand, they're getting a surge in demand, but on the other hand, if they're not able to deliver sort of that quality of stream to a lot of their target audience, then perhaps that, in some cases that could backfire. Whereas certain companies may, for just reasons of being better resourced, they can still deliver a crisp, high resolution stream. But anyways, so sorry to go on, but just wanted to touch on a few of those sectors.
No problem at all, Darren. It's just very interesting to see what these three sectors are being impacted by COVID, right? And I've had an opportunity for the last couple of months, privilege to be able to deal in the mask market, anywhere from the 3M 1860s to the 8210s, all the way to 3 plies and 4 plies, to ensure they're FDAC or NEOSH certified masks. Um, and one of the interesting things is you see all these firms that have been used to dealing in traditional commodities such as copper, gold, silver, right? And is masks in the past couple of months have become the new commodity. People have, now coined the term, right? Gold dust for masks, right? They're like the new gold dust out there. It goes onto the plane as masks, but comes off as gold, right? Because of the demand, how high the demand is for it, and all these firms converting to broker masks, basically, right?
Yeah.
And it's interesting because you look at price fluctuations for three-ply masks, right, in Jan and February, right, being going up to $1.10 when they're selling at 15 cents a mask, right,
Yeah.
shooting down and shooting back up. And it's just funny how they're very similar to what the markets are portraying today. It's a very good mirror of what the markets look like today. And to speak on that point, Darren, what are you seeing in the global markets today? All the way from what are the long-term or short-term correlations you are seeing in regards to not just Asia Pacific, but Europe, North America, and how they're all working with one another right now?
Yeah, so oftentimes global markets do correlate a fair degree when it comes to equities. Okay, so oftentimes investors, no matter where they are, whether it be in Asia or Europe, they do look to the US. And a nice benchmark, of course, would be the Dow Jones, quite oftentimes just quoted so widely in financial media. Obviously, the S&P 500 is, in my opinion, a better reflection, just because it's a broader index than the Dow Jones, which just consists of 30 stocks. But yeah, those correlations, they've been obviously higher in the last, call it, 2 months, just ever since the volatility started picking up in around mid-February. Shortly after the U.S. equity market had peaked, volatility obviously shot up. So in times of heightened volatility, what we get is a rise in cross-asset correlations. So what that means is you start having assets or markets, financial markets, which historically have had a more inverse correlation with perhaps the S&P 500, suddenly finding that it moves in sync. So Bitcoin would be one example. So in the peak selling of U.S. equities, right around, I would say, mid-March, around March 18th or 19th or so, there was a collapse in Bitcoin. I'm not sure if you watched it the day when Bitcoin expressed in US dollars fell below 4,000. And so there was panic selling. Basically, anybody who had a hedge fund or just had exposure, whether it's at a personal level or perhaps at a fund management level, if there was exposure on those markets which you were being bruised on, and perhaps leveraged where you were facing margin calls, then the immediate urgency, of course, at that point in time would have just been to liquidate whatever you could across accounts elsewhere in order to get the capital to meet those margin calls. And so that basically resulted in markets like Bitcoin just being thrown out with with the bathwater. And so it's a phenomenon which has occurred throughout history. It's not really just this recent crisis, but obviously Bitcoin's a newer market, being roughly just a little more than a decade old, and so it's a phenomenon which I would say has applied as well to the sort of fixed income U.S. Treasury market, which historically again has been inversely correlated quite often with U.S. stocks, but in this last call it 2 months, again, particularly during the peak selling around mid-March, what we saw was U.S. Treasuries actually, they sold off along with U.S. equities. And so oftentimes, again, that inverse relationship just kicks in because U.S. Treasuries historically, for the most part, and by most market participants, has been seen as a safe haven. And so with other assets like gold, we've seen this as well, where gold got absolutely slammed, contrary to what its advocates or proponents would have expected or would have preached. So leading up to the market crash in the S&P 500, gold was hanging just around the sort of 1800 level, and it was looking pretty strong, and then all of a sudden, like, it had that market sell off, which it was not immune to. So in the time since the peak selling that we've seen, again mid-March, what we've noticed in the last couple of weeks is a lot of these supposed safe haven markets, they've bounced right back. So gold has, it made almost you could describe it almost as a V-shaped recovery, rather sharp one. And we've seen something similar with Bitcoin. Arguably, one could have said that Bitcoin had broken a major uptrend support line, that extended all the way back to, it began probably around 2016, depending on how you draw the uptrend support line. But basically, it had broken briefly around mid-March, and during that break, obviously a lot of bears would have pronounced Bitcoin dead, or would have at least opportunistically looked to short it, even on a short-term basis, just around the sub 4,000 level, when it had briefly broken beneath that. But for those who still watch Bitcoin, you would have noticed that it's roared right back to, as high as above 7,000, 7,200 or so, just as of about 2 or 3 days back. And so, it's particularly, I guess, shocking to those who are new to technical analysis. If you just take some of those rows around technical analysis, such as, uptrend support line breaks as gospel, and you immediately short on that first, generic sell signal being triggered, then obviously things get very painful. Once you realize, okay, well, I'm kind of caught here in a short position, but technical analysis isn't meant to be overly simplistic, to the point where you only rely on one rule. And so I've always looked at technical analysis or pattern recognition from, the more holistic angle, which I adopt with, my own trading, where I'll look at a variety of indicators. And so, that's kind of, what I would recommend for anybody who's just looking to get into trading, or anybody who's even experienced as a trader but not using technical analysis sufficiently, or in the way that I have written about. I would obviously recommend anybody to at least weigh in with their views of how it's done. I can always be reached, but I have a bit of sort of experience just seeing how it can work quite profitably, when interpreted a certain way, or at least, at the very least, even if one is not looking to maximize returns, at the very least, ahead of market crashes, you can certainly get warnings from the way I use technical analysis. And one instance of that would have been a newsletter post I made public just one day before the S&P 500 peaked out. So February 18th, on Bloomberg, Refinitiv, and FactSet, basically all these institutional channels that pump out my content, they would have made available to some of the world's biggest hedge funds, warning that the S&P 500, the NASDAQ, was vulnerable. And I actually had a short call issued February 18th on those markets. Subsequent to that, I again, through my approach to technical analysis, I made a call on the VIX basically being ripe for a collapse. And so at the peak of the equity market selling, right around March 18th, 19th, I noticed the VIX was at an all-time high. And this just, again, it's not to my own horn or anything, but it's more just to illustrate that there is a lot to be had from pattern recognition. And we can all talk about the market fundamentals, which obviously is very important as well to be aware of, especially for sort of the longer term investment decisions. But certainly, for tactical purposes and also just to improve on general market timing, I would recommend your audience to look into technical analysis if they haven't already.
And thank you for that detail. Both people, right, in the last 2 weeks, around 10 plus million Americans have lost their jobs. But then at the same time, there are controversial hedge fund managers such as Bill Ackman, right, that really seem to do well in these volatile markets. This is what they bet on, right? This is what they wait for, recessions in volatile markets such as these, right? And recently, right, he made a $27 million bet by buying credit protection on various global investment grade and high yield credit indices, right? And this guy, right, is with Pershing Square Capital Management. And it's just interesting to see, right, how a lot of people are losing their jobs in this market, but some people are really, really capitalizing on it, right? And what are your thoughts in regards to the not only the ethics of this, but what the long-term effects could be?
Well, so on the ethics, I don't see, personally, I don't see it as being an issue profiting from a trader or hedge fund's perspective on market downturns. Look, there are these instruments available for people to make calls on, right? And I think the warning signs were there for a very long time. The credit bubble was unsustainable. The fixed income bubble was, arguably, and it's still very much there if you look at a very long term chart. And if you just think of how yields are, central bank overnight rates have been cut just to the lowest levels we've seen in a couple hundred years in a lot of instances, right? Depending on the central bank. So, look, the unsustainable bubbles that have been fueled by a lot of quantitative easing type money printing exercises, those bubbles, they're inevitably there to pop. And so looking at sort of the opportunists who profit obviously from other sectors surging, so not necessarily through trading financial instruments, but just through being an entrepreneur and servicing an addressable market. I don't see anything wrong with that. Look, if nobody's being harmed in the process, then I have no ethical issues with that. And obviously, if we're talking about medical supplies or even talking about vaccines, well, so the whole subject around vaccines is a complex discussion. I think a separate recording can be had just around sort of the debate on vaccines, but certainly it's not a straightforward issue. Anyone who thinks it is perhaps should do a little more research, just because it's by no means, I think, an overwhelming concluded discussion. I think it's a healthy one to have, actually. But when it comes to medical supplies like masks, certainly I think those companies who pivoted in that area, or whether to manufacture them or to broker them, I wish them all the best, actually.
Mm-hmm. It's just interesting, that $27 million bet made him about a profit of $2.6 billion by betting on the coronavirus outbreak. So very, very interesting, right? I think the key takeaway here is it's just interesting to see what personalities and what type of people and opportunists, right, are coming to light in regard to COVID-19, right? And to wrap up the call with the last question here, right, Darren? I want to kind of go back prior into the conversation where we spoke about gold, right? We are seeing heavy movements in gold volatility, which is unheard of, especially, during a bear market, as, it's seen as the safest option to where usually people put their money traditionally, right? And so now that we're seeing these massive volatile movements, right? Does BTC deserve the reputation as the new digital gold? Do you think how are central banks reacting to it? Is cryptocurrency and digital assets, do they have a brighter future in light of the coronavirus?
Yeah, so a lot of the central banks actually around the world have been, especially among the G7, have been exploring the idea of a central bank digital currency. And taking the lead there has been the PBOC, which has actually compelled a lot of other, call them competing central banks, to also give that idea a more serious look. And so even the U.S. Fed, even the Bank of England's former, Mark Carney, Mark Carney has recently left. They've all obviously had a really good look at the idea of a government supported initiative where existing fiat can be converted into a digital version. There already is a fair amount of digitized cash around. Just think of how we use payment apps currently with traditional digital wallets, whether it's provided by your phone manufacturer or by a company like Apple, or there are a lot of these wallets that are actually seriously taking a look at integrating crypto. And where I used to work at ICE Intercontinental Exchange, they actually have an initiative known as BACT, where they're looking sometime this year. It will be the second half, in conjunction with Starbucks and Microsoft, in rolling out a wallet which incorporates Bitcoin. So imagine you going to a Starbucks and being able to use your digital assets that way, right? So that will also incorporate at some point loyalty points, or the kind of credit or points that you can trade through playing video games. All that will be convertible and usable ultimately through that wallet. So I mean, it's coming. And with respect to what the central banks are doing, I mean, obviously what they're going to roll out will compete with Bitcoin. So although it helps legitimize the sort of the idea of cryptocurrency, but these are very different models, and we can have a different discussion around what those differences are. But yeah, just wanted to thank you again, Kuno, for giving me the opportunity to share these thoughts with your audience, and and anybody who's curious about the pattern recognition that I had alluded to. My website, tradablepatterns.com, which is just TRADABLEPATTERNS.com, has an educational newsletter where some of the content's free. So feel free, everyone, to just pop by and say hello. And my contact details are on there as well. My WhatsApp, my email address is all on there. So thank you, Kuno, for having me, and hope it was informative for everybody on board today.
Yeah, Darren, thank you so much for joining us today on Geeks of the Valley. And for listeners out there, Darren's quite an interesting personality. He has made some very successful market calls in the past, and even in these past couple of months. If you want a taste or a little bit of understanding of what he's really doing and how he's making these calls, please go to tradablepatterns.com and feel free to email him. That is Darren Chu at tradablepatterns.com. Thank you, Darren, and wish you a very safe and healthy rest of the next couple of months here as COVID calms down.
I appreciate that, Kuno, and you as well. Thank you.
Thank you.